Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. President Trump has moved quickly to impose new tariffs after the Supreme Court struck down the legal basis for his tariffs under emergency powers. He's put in place global tariffs under Section 122 of the Trade Act of 1974. So the rate is 15%. But these tariffs are limited to 150 days. Kind of underscores just how central tariff policy is to the president's agenda. For a closer look, I'm joined by Carol Schleif. Carol is the chief market strategist at BMO Private Wealth. Carol joins us from Los Angeles. Thank you for being here. I think we can agree that the decision by the Supreme Court wasn't surprising, but I'm wondering about the level of uncertainty now. Do you have a sense of that?
Piece of it depends on the size of business. The small and medium-sized businesses are scratching their head trying to figure out what to do, because first we had 10%, then we had 15%. It's only good for 150 days, and actually it expires the day that Congress goes on recess. On the one hand, these small and medium-sized businesses would benefit greatly from being able to get some refund, especially if the administration would turn around and say, okay, we'll pay some refund, because that gives them the opportunity then to turn around and pass some of that refund back to clients in terms of either holding prices steady or not increasing them, because they're at the point where they might have to increase them. I think bottom line, it does increase the uncertainty in the short run here. I think initially most businesses were pretty relieved is probably the wrong word, but gratified, if you will, that the Supreme Court did come down and say, look, countrywide tariffs are not doable. But it does make the administration go search out other particular industries and such, in terms of it does have alternative methods. And we know, we've said all along, as everybody has said all along, that President Trump really likes tariffs, and he's been on that theme for decades. And so we're going to have some level of tariffs that goes on, but it really is tougher for businesses. I was hopeful that they'd get a little more clarity. But all of that said, it's really still important to remember that, maximum uncertainty was probably April 2nd last year. And yet companies did okay anyway. They actually did better than okay when you look at GDP and where earnings came in and broadly that way. But yeah, it would be nice for business if they had some level of certainty. You've even got countries pushing back now in terms of India stepping back and saying that they're going to reassess things before coming to do to finish up the trade negotiations. So we'll see. Yeah,
the same is true for Europe. The EU's top trade chief basically saying that he will propose freezing the ratification of the trade deal with the U.S. until the Trump administration kind of offers some clarity. One of the things that I'm wondering about, though, because if you look at what the court had to say in its decision, the power of Congress really is at issue here. And obviously, if a tariff is a tax, then that is the purview of Congress. Now, we know we have the State of the Union coming up Tuesday, and I'm wondering whether you think that Trump will use this as an opportunity to pressure Congress into codifying something with respect to tariffs that has more of a bite and maybe could be more lasting.
I think he'll try. I'm not certain I would put it as very successful, especially because you've already had, you've had Congress start to push back on some of that with the House making the commentary around the Canadian tariffs and things like that. And because I think a lot of the Congress folks are hearing from their constituents that they don't like tariffs. They understand that tariffs in the long run are a tax on individuals, even if the suppliers have paid part of it because they've worked some of these deals through. By and large, no matter who you look at, there have been not just the New York Fed's analysis last week, but there have been multiple other analyses that show the bulk of who pays it is the consumer and or the U.S. business. And those folks are speaking to their Congress people saying, don't you dare codify anything that gives the president power to tax more. So I think he can try, and I'm sure he will, but I'm not sure it'll go very far in Congress.
Maybe we can talk a little bit about earnings. We've got some key results due this week. NVIDIA, right at the top of the list. Obviously, you've been tracking a lot of the narrative around AI disruption in markets, particularly in certain sectors like wealth management, software, obviously a big one. Where are you right now in looking at a company like NVIDIA and what it may say about where we are in this AI cycle right now?
Well, I think a couple things on AI, and we've been saying this for many quarters, that, sooner or later, the spend was going to need to taper because, a lot of people forget semiconductors are a cyclical industry. People are acting like they're not, like they're long-term, but for decades, semiconductors have been a cyclical industry. So sooner or later, that's going to taper. On the other hand, I started the week at a Women in Manufacturing conference in Florida, and I went to the same conference a year ago in the same timing, and I was really struck at how far along many of these manufacturing companies are in deploying AI, robotics, lots of other things. It's not just AI, it's also autonomous vehicles in the factories, it's robotics in the factories, and they're very far along in deploying that. And so I think that helps a lot of different use cases and things, so that it's not just about the AI data center build. It's not just about NVIDIA's earnings. It's about broader use and the fact that we've got stronger productivity that predates a lot of this, but is really starting to accelerate. And there's a chance that you continue to see even more of that. Now, that said, we don't think it's going to do away. It's not like regulated industries like wealth management or insurance or real estate or anything else can just ditch all of the regulated processes and start deploying ChatGPT by the end of the week, because it's not like we can upload client information into those things. There's a lot of stuff that has to happen. And so I think AI as an amplifier and not a job replacer is a key thematic that comes too. These companies are looking for employees who will roll up their sleeves, figure out how to use AI to make existing processes better. It requires employees to think differently and behave differently and maybe have a different set of skill sets where they're willing to lean into a lot more strategic thinking, a lot of client service sorts of things. I think AI doesn't replace employees. It amplifies what they do and maybe changes the tenor of what they do.
What you just described there has been happening in China for quite some time. Before I let you go, Carol, I want to ask about opportunities offshore. I know we started the conversation with reference to this U.S. tariff policy, but I'm wondering whether you're seeing opportunities offshore, particularly in the Asia Pacific.
Yeah, we are all around the globe, actually. And in terms of, you did have international bourses that outperformed the U.S. markets last year. You had ACWI up for over 20% for, I think, the third year running. And so there are a lot of opportunities. And it's interesting because if you look at like the World Bank and IMF numbers, they will tell you that global trade actually increased last year, despite all of the trade machinations going on with tariffs coming out of the U.S. And so I think those opportunities continue, particularly because in Southeast Asia, you've got, Japan in the recent elections, and part of that was predicated on increasing fiscal spend. You've got China that's been rumored for ages to be increasing domestic fiscal policy to get their consumer markets rolling again. You've got increased defense spend all around the globe, including Japan at record levels post-World War II. You've got Germany. So there's a lot of infrastructure and spend in general. There's a lot of trade that's rearranging itself. And that's all constructive because it means business is happening. It's happening in different places. It's more difficult for investors to keep track of, but it's a great environment for active managers and non-U.S. or global managers and long-short hedge funds. You got to do the work, but it's a great environment for it.
Okay, Carol, we'll leave it there. Thank you so very much. Carol Schleif is the Chief Market Strategist at BMO Private Wealth, on the road and joining us from Los Angeles today here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. So, as you know, the Trump administration is keeping U.S. tariffs in place even after the Supreme Court struck down the legal basis for those tariffs enacted under emergency powers. So global tariffs are now in place. They have been put there under Section 122 of the Trade Act of 1974. That rate is 15%. Here's the thing. These tariffs are limited to 150 days. Now, at the same time, the Trump administration said that trade deals made with China, the EU, Japan, and South Korea will remain in place. Even so, Europe's trade chief said he'll propose freezing the ratification of a trade deal until the Trump administration clarifies its policy. Meantime, in India, officials cited similar reasons for postponing talks in the U.S. this week on finalizing an interim trade agreement. So where does this leave China? Well, that's where we begin our conversation with Sean Stein. Sean is president at the U.S.-China Business Council, and he spoke with Bloomberg TV host Avril and Shery on.
I think the most important thing is that for China, this is really a bit of a win. And that's because under the rubric that the president has set to replace his IEEPA tariffs, it's potentially a 10% or a 15% global surcharge. So overall, what that means is it means that once those go into effect, then the overall tariff rate for most Chinese goods is lower than it was before. And so unlike with the EU, where it creates a lot of uncertainty, in the case of China, it means that the terms are now much more favorable to China than they were just before. And remember, if you think about the magnitude of this, if the surcharge is 10%, compared to where it was before, that's potentially $100 billion $100 million for every $1 billion of trade that's affected. So the cost reduction is really substantially lower. So it's a win for China.
Will they see it as a win, given that also it causes a lot of uncertainty? I mean, just trying to decipher whether this is a 10% tariff or a 15% tariff, how does this compare with fentanyl tariffs, most favored nations, and other countries as well?
Okay, that's a great question. So unlike most countries, the tariff situation on China before the Supreme Court ruling was really pretty complex. They had the baseline MFN rate, which was a few percent. They had the Section 301 tariff rates from Trump 1.0 and from the Biden administration, which were about 25%. Then on top of that, they had 10% fentanyl tariffs, and now 10% tariffs for reciprocal tariffs. So the part that's in play because of the Supreme Court's ruling are just those last two, the fentanyl tariffs and the reciprocal tariffs. So those today have fallen to zero, but when they go into effect with the new surcharge under Section 122, whether it's 10% or 15%, that's still going to be a substantial reduction from where they were before. So the MFN rate won't change, the 301 rates won't change, but the other tariffs will be lower once those go into effect under either scenario, 10% or 15%. So, yeah, China will see that as a win.
And to your point, I suppose, is also the idea that the Supreme Court striking down these tariffs also means there's less leverage for the U.S. president. I mean, what does that mean for the contours of the gathering between the two leaders late March into early April?
That is such an important question. I'm glad you asked that. And so leverage in a negotiation only really matters if one side has got more leverage than the other side. If both sides have leverage, the effect is much more ambiguous, or it tends to cancel the other side out. So where we've been is that you may remember that after Liberation Day last year, when the U.S. raised tariffs unilaterally on China, China responded tariff for tariff. They went toe-to-toe with the United States, and that's how we got into this escalatory spiral of triple-digit tariffs, which didn't serve either country's interest. And then you may remember that, despite the posturing, the U.S. blinked first and asked China to go meet them in Geneva so they could reduce those. So ever since Geneva, tariffs have really lost most of their edge as leverage for the United States. And so if you look at that as the first truce in the U.S.-China trade war of 2025 or of Trump 2.0, tariffs, then that was a front on that war that was fought to a standstill. And then the trade war moved to other areas, things like export controls and sanctions. And this is a case where also both sides have demonstrated they've got potentially significant leverage over the other, and they've largely fought to a standstill. Most notably, China has played the rare earths card, which not only hurt industry in the United States, but also around the world. And so this is a case where the U.S. absolutely has leverage, but the Chinese have counter leverage. So what that sets us up for is a meeting in Beijing in maybe less than 40 days, where the two presidents are not going to be able to use that leverage. And that means, ideally, this will be a situation where both sides have to focus on what would be a win for both countries. And as you've implied previously, what would be the biggest win for both countries is to bring some predictability to the business and investment climate so companies know how to invest and they know how to plan. Where we've been for the last year has been the constant instability and unpredictability has meant that investment decisions have gone unmade. It's meant the U.S. has lost manufacturing jobs every month since Liberation Day. So this potentially will bring a chance to bring some much-needed stability into this relationship. That'll be the biggest outcome.
The Trump administration has not necessarily even said who he's taking from the business community to China. So how well is the administration preparing for that state visit into Beijing, and what would your members like to see being achieved in order to bring some more certainty to the relationship?
Yeah, this has been shocking. I was just in Beijing before the holiday. And in meeting after meeting after meeting, what bled into all of those from Chinese officials was a mix of somewhere between being irritated and being apoplectic at the U.S. not preparing for this visit. Normally, when you've got a presidential visit, planning starts months in advance. By now, the two sides should be having regular calls. They should have exchanged lists of deliverables. They should have planned out the actual physical mechanics of the visit. But none of that has happened. And so it just shows that on the U.S. side hasn't done its homework yet to decide what it wants out of this trip. And the longer they wait, the harder it then becomes to deliver real deliverables that could help U.S. competitiveness or the U.S. economy. But you also hit at one other thing that I think is really important, and that is if we look at the president's other trips, he's always taken CEOs with him because business is what's on his mind, and that's what he's been focused on. That's especially true with China. But even now, as of Friday, they haven't decided if they want CEOs to go on this trip, much less started to extend invitations. So for a trip that's less than 40 days away, we don't have a single CEO that knows if he or she is going to be invited. But that just is, I think, sort of emblematic of the administration not having really done its homework on this visit yet. If I can add just one more thing that I think is really important to frame this visit, and that is, China is a country that takes protocol extraordinarily seriously, much more than most countries that I've dealt with around the world. And I think in this case, it's important because the Chinese recognize 3 levels of state-level visit or of leader-level visits. And so you've got working-level visits where a state leader will come and have official meetings. They have official visits which are much larger with more protocol. This is, for example, like Keir Starmer's visit from the UK just a few weeks ago. That was an official visit. But Trump's visit, both sides have announced it's a state visit, and that takes everything up to 11. It takes everything up much higher on the protocol front. And so, as part of that, there's the state dinner in the Great Hall of the People that could involve hundreds of people. And if President Trump shows up with a delegation of 5, then that just doesn't work out protocol-wise. And you can understand why.
Sean, you raised a good point about how the state level meeting is going to also perhaps raise the stakes. I mean, could you talk a bit more also about the extent in which there will be clarity for businesses as they have to adjust, in the meantime, their investment, their hiring decisions as well.
Yeah, so that's what everyone's hoping for, right? What does the U.S. want out of the trip? The U.S. wants some access to markets. It wants to sell aviation. It wants to sell airplanes. It wants to sell agriculture and maybe some other things. And what American business is pressing the administration to do is what it hasn't yet done. And that's to talk about the longstanding market access issues, the longstanding non-tariff barriers that discriminate against American products, American exports, and American business in China. And so that's what American business is looking for. And then what American business is looking for and what the Chinese are looking for, again, is a stable and predictable business climate so companies can plan. So if we're talking about what the level of tariffs will be coming into the United States, the administration wants to emphasize manufacturing in the U.S. But remember, what does the U.S. import from China? It imports final goods like, say, television sets, but it also imports a huge number of intermediate goods, things that go into American manufacturing and power American factories. Until we know in the long term what that's going to cost, how do you build a new factory and how do you price that in? So until we get stability, jobs will continue to hemorrhage from the United States because it's just impossible to invest.
That was Sean Stein, president at the U.S.-China Business Council, speaking with Bloomberg TV host Shery and Avril Hong, bringing you their conversation here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.